Good evening, everyone. Investors saying a big thank you to Janet Yellen. The Federal Reserve Chair said today policymakers will most likely keep interest rates right where they are now, near zero, through the end of this year. Wrapping up a two-day policy meeting and speaking at a news conference in Washington, Yellen also reassured investors that the U.S. economy is doing well enough for the Fed to make further cuts to its stimulus program, but it's not strong enough to see consistent growth without the central bank's help. Investors loved hearing that, and stocks took off. The S&P 500 index closed at a new record high of 1957. The Dow, which was in the red before the Fed announcement at 2 p.m. Eastern Time, shot up almost 100 points, and the Nasdaq rose 25 points. Steve Leisman was at that Fed news conference and has more on what Yellen said and what it means for the economy.
Was it an upgrade or a downgrade? For the Fed today in the U.S. economy, it was actually a bit of both. The Federal Reserve upgraded the U.S. economy in its statement today, saying it was rebounding from the severe winter weather swoon. At the same time, because of the economy's contraction in the first quarter, much stronger than expected, the Fed had to downgrade its forecast for the full year by 0.7 of a percentage point to 2.2%. Still, Fed Chair Janet Yellen said she saw gathering strength in the economy.
I think there are many good reasons why we should see a period of sustained growth in excess of the economy's potential. We have a highly accommodative monetary policy. We have diminishing fiscal drag. We have easing credit conditions. We have households who are becoming more comfortable with their debt levels. We have rising home prices and rising equity prices and an improving global economy, at least in my estimation. So I think all of those things ought to be working to produce above-trend growth. And over a number of years in which, admittedly, growth has come in at a disappointing level, we've still seen the labor market broadly improve, and I expect that to continue.
At the same time, Yellen signaled that she was not worried about recent readings of higher inflation. She indicated it would not be an immediate factor for the Fed to hike interest rates anytime soon.
The recent evidence we have seen, abstracting from the noise, suggests that we are moving back gradually over time toward our 2% objective, and I see things roughly in line with where we expected inflation to be. I think if you look at the SEP projections that were submitted this time, you see very little change in inflation projections of the committee.
The market liked what it heard, a little bit better growth. The Fed gradually reducing the amount of stimulus in the economy through tapering its bond purchases and still on track to raise interest rates, but not until next year, and then only gradually. For Nightly Business Report, I'm Steve Leisman.
And David Kelly joins us now to talk more about the Fed. David, welcome. Stock investors seem to see what Janet Yellen said today and did today as green light. Do you see it that way?
Yeah, I think it was a generally positive report on the economy, and I think it's correct. The economy is picking up clearly in the second quarter of the year, and I think it'll pick up. I think there's a good chance it will grow at above a trend pace over the next 2 years. What I thought was interesting, though, is long-term interest rates actually came down today, and I do think the bond market is a bit complacent here. I mean, the Fed, although it changed its forecast, it didn't change very much about what it's doing short term. But it did say that the individual members did say they thought that short-term interest rates would be higher at the end of 2015 and 2016 than they had thought before. That ought to have pushed long-term interest rates up, and it didn't. And so I think there's something of a bubble in the bond market at this stage. I don't think it's a huge bubble, but there's a bubble there, and I think interest rates are too low given the outlook for the economy.
David, I want to follow up what you just said right at the beginning of your answer to Tyler's question, that this is a positive for the market. So, okay, good for investors. But what's going on in the economy and what Janet Yellen said today mean if you're an American that's out of work, or you are someone that you have a job, but your paycheck really hasn't been growing much, or you're somebody trying to sell your house? What does all of her comments and her forecast mean for those people?
Well, I think that the story in the economy is actually getting better on all of those fronts. What we're seeing is it's not so much the economy strengthening, but the labour market is tightening. The unemployment rate, just since the last time they put out forecasts a few months ago, has come down another 0.4%. So we're now at 6.3%. The Federal Reserve regards 5.4% or 5.3% as roughly full employment. So we're within 1% of that. And as unemployment comes down, that is helping, obviously, some people who've been long-term unemployed. We've seen a decline in that. And it's also beginning to push up wages. So we are seeing some real wage growth. That's good. And also when it comes to home prices, because we're not building enough homes and mortgage rates are still relatively low and the economy is expanding, home prices continue to go up. So this stuff is improving. It's not going to improve any faster because of what Janet Yellen said today, but it is definitely on the mend.
David, what would you like to have heard or seen today from the Fed that you didn't? And how do you grade the Yellen Fed so far? Admittedly, it's a short stint.
Yeah, I would like to see a more determination to bring interest rates, the federal funds rate, back to a normal level over the next few years. I think that all this quantitative easing and this very low interest rate environment, it really is a double-edged sword. It has helped push up asset prices. I think it threatens us with inflation in the long run, but it isn't really building the productive capacity of the American economy. And what I'd like to see is a normalization of interest rates a little bit more rapidly, which I think can actually get people back to more normal investing, because I think this is still a very extraordinary policy for an economy that really clearly is on the mend.
Mm-hmm. So, everybody always talks about on interest rates, what's going to be the timeline, end of this year, next year, the year after. But what about where interest rates are going to be? What is the number? What are you expecting? 4%, 5%, 6% higher? Can you put a number on it?
Yeah, I think that by the end of this year, on a 10-year Treasury bond, will be somewhere between 3 and 3.5%. By the end of next year, maybe somewhere closer to 4%. I do think interest rates will go up. But one of the other things in this statement today is they have pushed down their long-term estimate of short-term interest rates. And that really, in the long run, the American economy is going to grow a little bit more slowly than they thought. That does actually imply that long-term interest rates, in the end, won't be quite as high as we thought before.
All right, David, thank you very much for being with us this evening. David Kelly is with J.P. Morgan Funds.